Managing Partners of Keystone Financial Group. This is the second in a series of short video tutorials designed to help you gain a clear understanding of Bank on Yourself and the practice of using specially structured whole life insurance contracts as part of your financial foundation. In this video, we will cover what is probably the single most important aspect of the concept, which is the tremendous financial power that comes from your ability to access money through policy loans. The unique features of the whole life contract give you the ability as policy owners to access financing from the insurance company. You can borrow 85 to 90% of accumulated cash values at any time for any purpose, and there's no qualifying process or any applications to fill out. Once you determine how much of the cash value you have available, the insurance carrier sends you the money. Technically, the loan proceeds are actually coming from the general fund of the mutual insurance company, secured by the death benefit of the insurance policy as collateral. One of the key features of this process is what we call non-direct recognition. Non-direct recognition simply means that when you borrow from the policy, the growth continues in the background as if you didn't borrow a penny from the policy. It's this non-direct recognition feature that allows the growth to continue as if the loan never occurred. The non-direct recognition feature creates the powerful element of what Albert Einstein called the eighth wonder of the world. Of course, I'm talking about compound interest. Einstein said, "Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it." The unique feature of the whole life contract, combined with the non-direct recognition accounting for policy loans, allows you to access and use your money today, but still capture the long-term compounded growth on the very same dollars in the future. To demonstrate this further, let's look at a snapshot of the actual illustrated values from an insurance company illustration system. The chart you are seeing has the illustrated values of an actual policy with no policy loan. It includes the guaranteed growth values on the left side of the chart. The right side of the chart shows the values including dividends at today's rate. At age 50, there is projected cash value of just over $126,000 and a death benefit of over $471,000. This slide shows the same projections with the loan being taken at age 46. The chart also shows the loan being repaid over a 4-year period, including 5% interest charged by the insurance company. As you compare the two charts, it is important to note that the cash values and the death benefits after the loan was completely repaid are exactly the same. This is a demonstration of the non-direct recognition in action. The policy continued to grow at exactly the same rate whether the loan was there or not. We always recommend repaying any loans taken. These policies provide flexibility in both how much and when the loan is repaid. This chart shows the same $15,000 being taken at age 46. However, the loan this time is not being repaid. Any outstanding loan would be deducted from the death benefit at the time of death. Existing loans also reduce the cash value by the amount of the loan plus any interest. This is why repaying back any existing loans maximizes the values of the policy. So again, because of the unique features of the whole life contract, combined with the unique non-direct recognition accounting for policy loans, you can access your money any day, but still capture the long-term compounded growth on the very same dollars in the future. This is one of the most important attributes of the Bank on Yourself concept that you need to understand. In the next video, we're going to talk about the same real-life applications in your financial life in which you would utilize this concept. Thank you for your time and attention, and I'll see you in the next video. As we conclude, it's important to understand that with any financial strategy, there are advantages and there are trade-offs. Policy loans, accumulated interest, and if not repaid, could affect the longevity of the policy, impact the cash value, and decrease or terminate the death benefit. Allowing a policy to lapse may have tax consequences. Bank on Yourself policies that are incorrectly structured or set up using the wrong type of life insurance may be subject to loss of the tax benefits or other benefits mentioned. You should always work with a qualified insurance professional who's experienced with building bank on yourself type policies to ensure that your policy is set up correctly to receive the benefits mentioned. Thanks again for your time, and I look forward to speaking with you in the near future.